Something has changed in the silver market, and most people have not noticed it yet. On the surface, it looks like just another cycle of volatility. Prices surge, then collapse. Headlines scream panic one week and optimism the next. Traders rush in and rush out. Analysts argue about charts and forecasts. To the casual observer, it looks chaotic but ordinary, just another commodity moving up and down. But underneath the noise, something deeper has begun to shift. The physical structure of the silver market is tightening in a way that rarely happens. It is not happening because of hype. It is not happening because of speculation. It is happening because the real world is consuming silver faster than the system can replace it. And when that kind of imbalance begins to build, it rarely resolves quietly. Silver occupies a strange position in the financial world. It is both a precious metal and an industrial material at the same time. It sits between two different systems. On one side, it behaves like money, something people buy during periods of uncertainty or financial stress. On the other side, it behaves like a raw material, essential for modern technology and manufacturing. That dual identity is what makes silver unique. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Unlike gold, which mostly sits in vaults and jewelry boxes, silver is constantly being used up. It flows into electronics, solar technology, medical equipment, high-precision components, and thousands of industrial applications that most people never think about. In many of those uses, the silver is dispersed in such small amounts that it is never economically recovered. Once it is used, it is effectively gone. This creates a quiet but powerful dynamic. Every year, factories, technology companies, and manufacturers require more silver to keep production lines moving. At the same time, the amount of newly mined silver entering the market has struggled to keep pace. For years, this imbalance remained hidden because stockpiles built up during earlier decades were able to fill the gap. When demand exceeded mine supply, the difference could simply be drawn from above-ground inventories. But those inventories are not infinite, and over time they have been shrinking. Across multiple exchanges and storage hubs, available silver inventories have been trending lower. Physical bars have been leaving vaults faster than they are being replenished. Some of this metal is being shipped to industrial users. Some is being accumulated by investors. Some disappears into long-term storage and rarely returns to the market. Wherever it goes, the result is the same. Less metal remains available to meet future demand. At the same time, the industrial appetite for silver has been expanding year after year. Modern electronics rely heavily on silver because it is one of the most efficient conductors of electricity known. Solar energy systems require silver to capture and transport electrical currents efficiently. High-performance electronics depend on silver components that cannot easily be replaced by cheaper materials. Technology keeps advancing, and as it advances, it quietly increases the amount of silver embedded inside the infrastructure of modern life. Factories cannot simply pause production when the price of silver rises. The metal represents only a small fraction of the total cost of many high-value products. A sophisticated electronic device, for example, may contain only a tiny amount of silver relative to its total manufacturing cost. If the price of silver doubles or triples, the impact on the final product is often small enough that manufacturers simply absorb the increase. Shutting down production would cost far more. That means industrial demand for silver is remarkably insensitive to price changes. Even when prices rise sharply, factories continue purchasing what they need. Supply, however, does not respond nearly as quickly. Silver mining operates very differently from commodities like oil or natural gas. If demand for oil increases, producers can often increase output relatively quickly by expanding drilling operations or accelerating production from existing wells. Silver does not work that way. Most silver is not mined as a primary product. Instead, it is produced as a byproduct of mining other metals such as copper, lead, and zinc. When companies open a mine to extract those metals, silver is often recovered along the way. But that means the supply of silver depends largely on the economics of entirely different metals. Even if the price of silver rises dramatically, mining companies cannot instantly expand production unless the primary metals they are targeting justify the investment. Building new mines takes years. Permits must be secured. Infrastructure must be constructed. Exploration must confirm viable deposits. By the time a new mine finally begins producing metal, the market conditions that inspired the project may already have changed. This creates an unusual situation where both supply and demand are slow to react. Demand keeps growing steadily as technology evolves and manufacturing expands. Supply, meanwhile, struggles to increase because the easiest and most accessible deposits have already been developed. The result is a tightening gap between how much silver the world needs and how much new silver enters the system each year. And that gap has been growing. At first, markets barely noticed. Inventories quietly filled the difference. But as those inventories shrink, the system begins to behave differently. When stockpiles decline, the market must find another mechanism to encourage holders of physical silver to release it. That mechanism is price. Higher prices act as a signal. They encourage investors, institutions, and private holders to sell metal they might otherwise keep stored away. In effect, rising prices pull silver out of hiding and bring it back into circulation. But this process rarely happens smoothly. Instead, markets tend to move in violent bursts. A sudden shortage or surge in demand can trigger a rapid price spike as buyers scramble to secure metal. That spike attracts sellers who are waiting for higher prices. As new supply enters the market, prices pull back again. Then the cycle repeats. Volatility becomes the defining characteristic of tightening commodity markets. What we have seen recently fits that pattern almost perfectly. Prices surged rapidly, drawing global attention. Then they collapsed sharply, creating confusion and panic among traders who had rushed in during the rally. To many observers, the collapse looked like the end of the story. But in reality, it may only be the beginning. Short-term price swings often distract from the underlying fundamentals, driving a market. When prices fall suddenly, headlines focus on the decline while ignoring the structural forces still operating beneath the surface. Yet those forces have not disappeared. The industrial demand remains. The mining constraints remain. The shrinking inventories remain. Nothing fundamental about the silver supply chain has changed. Markets often behave this way during periods of transition. Participants focus on daily movements while missing the larger cycle unfolding over years. Traders respond to momentum and news events, while structural imbalances quietly continue building pressure. Eventually, that pressure reaches a point where the system must adjust. Sometimes the adjustment comes gradually. Prices drift upward over many years as supply slowly struggles to keep pace with demand. Other times the adjustment comes suddenly. A seemingly minor disruption can trigger a cascade of reactions. Industrial buyers rush to secure supply. Traders scramble to close short positions. Investors flood into the market seeking protection against uncertainty. When all of these forces collide at the same time, prices can move far faster than anyone expects. That possibility is what makes the current silver environment so unusual. The world is entering an era defined by technological expansion, energy transformation, and growing demand for advanced electronic systems. Each of those trends relies heavily on materials that conduct electricity efficiently. Silver sits at the center of that requirement. And unlike many other commodities, silver cannot easily be substituted without sacrificing performance. At the same time, the global financial system is carrying unprecedented levels of debt. Governments continue issuing new obligations to finance spending. Monetary policies remain deeply intertwined with economic stability. In environments like this, investors often begin rediscovering tangible assets. Physical metals have historically served as a form of insurance during periods of monetary uncertainty. They represent something outside the traditional financial system. Silver, because of its dual identity as both industrial material and precious metal, becomes particularly sensitive to these shifts. If industrial demand continues rising while financial demand also increases, the pressure on available supply could intensify dramatically, and that is when markets can become unpredictable. Because once a physical commodity enters sustained deficit, the math becomes difficult to ignore. Each year the world consumes more metal than it produces. Each year inventories decline a little further. Eventually the system must confront the imbalance. And when it does, the adjustment rarely happens quietly. Right now the silver market stands at the edge of that possibility. Most people are still focused on the recent volatility. They see a price chart moving up and down, and assume the cycle will simply repeat like countless others before it. But cycles do not last forever. Sometimes the structure beneath them changes. Sometimes the system itself begins to shift. And when that happens, the signals appear long before the wider world notices them. The delivery cycle in silver is beginning to show those signals. And the deeper you look, the more difficult they become to ignore. What makes the situation even more unstable is the structure of the trading system surrounding silver. A large portion of silver is traded through futures contracts rather than physical metal changing hands. In normal conditions, this system functions smoothly. Contracts are bought and sold, positions are rolled forward, and the majority of participants never actually take delivery of the metal. But when physical supply begins tightening, that system can experience sudden stress. Many traders operate under the assumption that the metal exists somewhere in the system and can be delivered if needed. On paper, this appears reasonable. Metal is stored in vaults, accounted for in inventories, and connected to contracts through a complex web of financial agreements. However, reality can become complicated when the metal must move from one location to another, or when it must be converted into specific formats required for delivery. Transportation delays, refining bottlenecks, and logistical constraints can suddenly matter much more than they did before. In calm markets, these details are almost invisible. In tight markets, they become critical. A situation can develop where metal technically exists, but cannot be delivered quickly enough to meet immediate demand. When that happens, traders who previously felt comfortable maintaining short positions may rush to close those positions. That rush can amplify price movements dramatically. A wave of short covering can send prices sharply higher in a very short period of time. At the same time, industrial buyers who depend on steady supply may decide to secure additional metal as insurance against shortages. Their purchases add another layer of pressure to the market. The result is a feedback loop. Rising prices create fear of missing supply. Fear of missing supply creates more buying. More buying drives prices higher still. Then, just as suddenly, the market can reverse. When prices spike too far too fast, some holders release metal into the market. Traders unwind positions. Prices retreat sharply. To outsiders, this appears chaotic. But beneath the chaos, the underlying imbalance remains. Demand continues rising. Supply remains slow and inflexible. Inventories gradually decline. And every cycle of volatility reveals just how fragile the balance has become. The silver market may continue to swing violently in the short term. Prices may surge, collapse, and surge again. Headlines will focus on the drama of those moves while missing the deeper story unfolding underneath. But the real story is simple. A metal essential to modern technology is being consumed faster than it is being replaced. The system has relied on stored inventories for years, and those inventories are slowly shrinking. Eventually, the market must reconcile that reality. When it does, the adjustment may not look like a normal commodity cycle. And the moment that shift becomes obvious to everyone else, the dangerous part of the silver delivery cycle will already be underway, and that is why this moment matters. The volatility, the sudden drops, the sharp rallies, all of it is noise compared to the deeper shift happening underneath the surface. Silver is quietly moving from a comfortable supply environment into a tightening physical market where demand keeps growing, but new supply cannot keep up. For years, the system relied on stored metal to fill the gap, but those reserves are slowly shrinking. At some point, the market will have to confront that reality. When that happens, prices will no longer be driven by speculation alone, but by the simple question of who actually has the metal and who still needs it. And when a market reaches that stage, the cycle doesn't just become volatile, it becomes dangerous.